Institutional DeFi, let's go. Come on. Good morning, guys.
I feel like Christine needs to go viral on TikTok with this institutional DeFi like energy thing.
Yeah, I'm ready. I'm ready. Someone help this boomer.
We are ready. And today, this clip is going to be on TikTok tomorrow. Hey, everyone. Thank you so much for joining us today. You guys just heard me talk for 20 minutes about institutional DeFi. And today, we're going to hear it from the source. And why don't I let you guys talk, introduce yourself really quick. And yeah, we'll start with you, Christine.
Sure. Hey, everybody. I'm Christine Moy from Apollo. Apollo is a $750 billion asset manager with businesses in credit, equities, real estate, and retirement services. And basically, my role is to essentially help Apollo navigate this change and navigate what this can be potentially like the most disruptive thing to finance, to make sure that we don't get disrupted, but also to make sure that we're identifying opportunities to shift with this next generation of investors, with all of you. So really excited to be here. I've been in digital assets for about a decade. Previous to Apollo, I built and led JP Morgan's blockchain program. So if you've ever heard about JP Morgan tokenizing $2 trillion of treasuries in US dollars on a permissioned Ethereum blockchain that no one knows about, I led that work and I'm super proud. So, I'd say that my life's mission has been around real world assets on chain and now institutional DeFi, which we're going into the golden age of.
Hey, Tarun, I think I know a lot of you, so I'll keep it short. Have been kind of around since the word DeFi existed 7 years ago, and I think it has changed so much over 7 years that, we're at the point that you can actually do this now, so.
None of these guys need an introduction, but thank you so much. Let's kick it off today. We want to talk about where we're going in institutional DeFi. Christine, we've both spent pretty much the last decade thinking about where this moment is today, and it's finally here. So, why is now the right moment? You've seen basically the start of this to now. Why now?
Yeah, I would say that in the past decade, we've just been building up to this moment. Like when I started in 2016 to 17, we had this vision for how blockchain technology could change finance, but we weren't exactly sure how it would work. And this is kind of the time frame where we were experimenting with colored coins on Bitcoin. Ethereum had just launched, and we thought that the idea of smart contracts institutionalized was definitely useful in the context of financial products that would pay dividends and pay interest on loans and would manage life cycle events. However, at the time, and especially from the context of being at a large bank like JP Morgan, there wasn't industrial scale like blockchain. There was blockchain that was new, but it hadn't really been through, kind of the rigors yet of, I guess the adversarial environment that it has in the past decade that it's, that it survived. There was also at that time a little bit of blockchain, not Bitcoin, going on as well, where institutions were trying to segment between the technology versus the asset class. Overall, I would say we've been laying the groundwork piece by piece. One of the first things that had to be done was obviously, kind of enabling blockchain technology that could scale, that could handle the velocity and volume of these type of assets. I think all of you in the Solana ecosystem understand what this mission is. Additionally, I remember when I was tokenizing bonds for the first time in 2017, we were okay, we can create a bond, but we can't create dollars. How does that work? So then stable coins became a next foundational piece. Additionally, while there has been a lot of experimentation around tokenization, there wasn't really a clear view on sort of what the business use case was for. And from the context of a bank, a large institution, it's always been about cost savings and efficiency. But I can tell you, after a decade of trying to drive cost savings and efficiency use cases, no one cares about that, really, right? Really what everyone wants is how to generate alpha, how to do something better, faster, cheap, I guess cheaper, but that's just table stakes. And so I would say between having great blockchains like Solana, having stable coins, and then also having a ready audience of investors. Crypto is a $3 trillion market. We compare that to the high yield market, which we think is a real market at 2 or 2.5 trillion. like it's a real market now. So, being able to build products, like we're just right at that inflection point.
Amazing. And Tarun, you've been here since DeFi was born. What do you think? What do you think? Is DeFi ready
birth
to
DeFi?
take? Yeah.
I was in the
Are you
group
father?
chat
Yeah.
where the Dharma founders, who then got bought by OpenSea later, came up with the term. In 2018, it was like basically Maker, and then Uniswap was a grant project in Williamsburg. So it was that was kind of like how it started. Actually, San Francisco was the home of DeFi in 2018, which is how everything switched since then. But I think one kind of interesting historical lens to take as to the why now is, when DeFi first started, it was very much an open research problem, and things were kind of untested. People didn't know what mechanisms would work, and people were just sort of experimenting with this idea that, hey, in a permissionless financial system, you actually have to build a lot of the products totally differently, right? Like, you have to think about different types of risks. You have to think about different types of Sybil attacks, different types of Oracle attacks, all these types of things that in TradFi you would just go cry to a judge if something went wrong, right? And no offense. And so that type of stuff took a lot of time to, A, for people to build stuff, B, for people to get hacked so that you could see what the worst case looks like. Then C, you needed a lot of new assets. And I think people in TradFi maybe are slightly derisive towards meme coins, but I generally think getting all these new assets was a way of testing all the infrastructure through the craziest ups and downs, right? Like through an FTX collapse, through kind of a boom on the other direction. And as much as it pains me as someone who wrote a lot of the early DeFi research and still likes to try to write new stuff, is a lot of the OGs in DeFi are kind of sad nowadays. They're like, oh, there's no new protocols, and they're kind of crying about it. But there's sort of the sense in which that means that DeFi has succeeded. Like, we've gotten to the point where people understand the risks enough, and now it's about trying to build the thing that was the dream in the 2017 ICO boom of the super app, the app that serviced every type of asset, the app that kind of did what Cindy just showed you of you can use things as collateral anywhere, you can aggregate yield from arbitrary sources. I think one of the reasons you see people really interested in moving their assets on chain, whether it's in traditional finance or whether it's fintechs, is everyone is realizing that the super app will not happen on existing rails. It will have to happen here. And I think we've seen this evolution from 2017. Everyone thought super apps would be L1s. 2020, 2021, everyone thought sort of the super app would be single DeFi protocols that built their own wallet and scaled vertically. And now we're kind of at this point where actually people realize, hey, actually these structured products and kind of composable finance, which doesn't require any new protocols, new mechanism design, it's more about composing existing known trusted things, is the way to build safe, reliable yield.
Actually from you're just conjuring my memory, I've been definitely dreaming about this since DeFi popped off and I learned how to, bridge assets. Still pretty awkward with wallet. But, I kind of thought, what if we could put our assets or real assets, using these DeFi protocols? But in reality, what I'd always imagined was that these DeFi protocols would be these engines, these little engines behind a single pane of glass, behind a really great user experience. And in which case, you would actually just get what you wanted. It would all be fully automated. It wouldn't have the hundreds or thousands of team members to support the system. And literally you would just do what you needed to do, which is I think how the vision that you set forth in institutional DeFi at Drift. Basically, you don't have to necessarily operate with the primitive itself. You're just trying to do things. You're either trying to generate yield, or you're trying to trade, or you're trying to kind of leverage something as collateral. And you just put it into an easy to understand interface, and then in the back end, DeFi sort of takes over and automates everything at a killer cost base that I know no one cares about, but actually, in the broader scheme of things, is actually quite disruptive when you think about, as Cindy said, these traditional financial institutions that spend millions of dollars enabling this technology and thousands of people supporting that technology.
I think that's the big unlock of permissionlessness, right? an incremental user, incremental dollar being onboarded into the system requires no more effort than what is already there. So scaling from where we are today with DeFi, I think it's like 20 billion market, 200 billion to 2 trillion is actually, it doesn't require any more costs. So that's a huge unlock in what we think is going to be the next step for what on-chain financial institutions might look like. But Christine, you spent the last couple months in the crypto maze, and I'm very interested to ask you about your wild journey in the maze. What's been interesting and what stuck out to you as you talk to DeFi builders today.
I love it, by the way. I feel unlocked, finally, after like 10 years behind the walled garden, if you will. But no, I mean, like, it's actually proving out everything that I had thought about behind the garden, if you will. Like, I had always thought, like, oh man, if we could get out to permissionless DeFi, like, innovation would be so fast because you have literally like handfuls of teams that are, trying to solve these problems, but they're all doing it their own way. Like, they're all bringing their diversity of thought and background and experience. They're all trying it. Like, I think, was actually talking to Robinson at Wormhole this morning. It's like, you can just do things, right? Like, they're all like trying it, but they're trying it with real money, which, by the way, like, immediately, your feedback loop is like right there, right? Like, it's not like, when you're at a large institution and you have one team that's composed of a certain set of people that think a certain way and have preconceived notions about how things are supposed to be, and then it takes them about a few months to write the requirements. It takes them a few months to like socialize that with engineering. Then it takes a few months for that to get prioritized. Then like a year or two later, you're trying to build something. You've built this massive like Ferrari. Then you start testing it, and then you realize either it doesn't work or nobody cares, right? Like, you don't get all of that in DeFi because of the really tight feedback loop. And so I have been impressed and astounded by the DeFi community and how quickly we've been able to innovate and how people have brought their, A game. And the interesting thing is, like, everyone here is on this mission, right? Like, also, I would say, in contrast, okay, we're doing this as our job. This is like our daily function. Like, you all are here. It's hard. It's new. It's pioneering. But you all are here because you're looking to change the world. And, that's been, really inspiring and motivating to me as well. So, for my part, I'm like blockchain boomer. So please be patient and please educate me on all the different protocols and like what's happening. And I need to learn about all the risks and make sure I can explain it to all my compliance people. But, really excited about like what's coming together and how fast it's moving.
This is a true TradFi DeFi convergence. I think Christine is a true force of nature, bringing energy, movement to DeFi, and I think the DeFi community has also been very inspired by what you've.
That's why she has to go viral on TikTok.
Exactly.
Just make sure nothing blows up.
That's our job. Well, that's our job in the audience. And Tarun, on your side, Gauntlet also entered DeFi pretty much last year in a more structured product sense. Since then, you guys have pretty much been a top 10 DeFi protocol by TVL. Can you tell us a little bit about your journey from starting in DeFi as well?
Yeah, so I think in 2018, DeFi, like I said, was a research project, right? There was sort of this Cambrian evolution-like behavior where someone would write a smart contract. There would be 5 million bots that would like try to either exploit it or interact with the contract, and then you'd have this sort of like survival of the fittest economic experiment. So like someone wrote a contract, they don't really even know why the mechanism works, but people would put money in it, and they'd put a lot of money in it, and if it survived, then people were like, okay, I'm willing to keep trying. So that's actually how Uniswap started in a lot of ways. Is that even though there were sort of people who had talked about the same design, someone just made it, put it online, people didn't lose money. This is a very natural state when you're a very early stage endeavor. Because people really didn't understand the theory of like, oh, well, what does it mean to have impermanent loss? What does it mean to have this kind of like convexity loss? I'm an LP, I'm not really thinking about it. And I think what happened over time was that people started to really understand the risks. There was kind of the 2018 to 2021 era where infrastructure was expanding much faster than risk understanding was working, and I think that was why there was a ton of research in that era. But from 2022, I think the FTX crash sort of being the best risk event ever, right? It's like when I was in trading, there were always like, hard coded into all the back tests were always like, these particular days, always run the back test 10 times on and like make sure you don't lose money, right? And like I think the FTX collapse actually serves as that for a lot of protocols. But I think since then, people have really, DeFi just matured to the point where things feel less like research. And I say this as someone who I feel sad saying that, but it's much less like research and much more like a product that's ready to launch. And in some ways, that's like the best time to invest. So I think that in a lot of ways, that's why DeFi is so underpriced relative to the rest of the market right now. Yeah.
Capitalists are here.
Yeah, because it actually works and it actually is generating real revenue. And so I think from the risk side, I think the main things to understand are, A, you need way more real-time monitoring than in normal TradFi, right? There's no 4 o'clock close and, okay, I can shut down my machine and, test why I lost money. The second thing you have to really be cognizant of is new contracts, it's a permissionless system, new contracts can come and interact with your code, and they may actually increase risks to your code that you did not foresee because you kind of assumed you lived in isolation. And in a lot of TradFi, you can get away with that, right? You can get away with saying like, I'm only trading on NYSE and like, I don't care about the CME. I'm never gonna look at the data. But on-chain, you actually do really have to look at flows everywhere. You need to look at where stablecoins are moving. You have to look at how people are using bridges. You have to look at which contracts seem to be attracting flows, yet no one knows what it is. And I think like that cat and mouse game is something that took a while to understand. I think now people have a lot more kind of conscious understanding of that. And so I think the future is really more about composing what we have rather than that many new mechanisms. And I think that's why you can bring in a lot more traditional financial assets because people have a lot more understanding of the security properties of the risks. And I think like that stuff always sounds boring to everyone who's like, oh, like I want the fanciest new technology. But that's the thing that will actually get 1 billion users, not like whatever was promised in 2017, 2020.
Absolutely. Love that. What I think what we're here to talk about today as well is, private credit and the ACRET launch in Solana. Tell us a little bit about how you're thinking about why ACRET was the first asset that you guys are tokenizing, and what are your plans for tokenizing more?
Yeah, sure. So just a broader context on Apollo for those of you that have not been, sort of focused on it. As I mentioned, significant asset manager. Of the 750 billion that we have, 550 is credit. And essentially, like, we're in the business of generating excess spread per unit of risk. What this means is generating alpha that is above and beyond what you can access in the public market, so like fixed income and equities, of course. And the way that we do that is a few different ways. Like, the first thing is we have developed a huge proprietary credit originations engine. So we've literally incubated or invested in or bought credit originations platforms that create different types of credit products, like leases for airplanes, fleet leasing. So when Amazon has like a bunch of trucks that need to like deliver things, like we have a company that like manages all of those like delivery trucks and kind of the leases inherent to it. We lend to both middle market companies and also large cap companies. I don't know if you've seen, for example, we had lent to Intel $11 billion for them to build like a new chip manufacturing center, as an example. And then it even spans to trade receivables and many, like even financing for like if you want to get a hot tub. So the reason why we do that is because of that proprietary originations, that's how we get additional credit spread that we can pass on to our investors. So that's like the first thing that's differentiated about us. The second thing is purchase price matters. We have long historically been like a value investor through all different types of markets. And then the third thing is that we always have alignment with our investors. Like, for example, like in our tokenized fund, like 90% of like what's in a fund in any given Apollo fund, but especially that one, Apollo has invested directly with our own balance sheet. So we are aligned with all of you from an investment perspective. So although we cannot guarantee returns, we can guarantee that we definitely don't like losing money, and we're structuring for, protected downside. So with that broad context at play, our mission has been to democratize access to this alpha generation, if you will, along the domain of significant institutions, sovereigns, pension funds, retirement services institutions as an example, but why not everybody else? And so, we've done like many different things, but specifically in digital assets, we're looking to broaden access to this alpha generation, and like that's sort of the reason why we're on chain. In terms of like why, like how we thought about like what strategy to go out with. Definitely looking for something that's daily subscription, daily NAV, and has like a redemption, a more liquidity and redemption mechanism that can accommodate like the interest in like the crypto ecosystem. So yeah, it's been like great experience, tokenizing our private credit fund, and definitely am interested in tokenizing more to the extent that there is demand. As I mentioned, I've been doing this for about a decade. I'm not tokenizing anything that people don't want anymore, right? And so, I think it's up to the ecosystem, this community, to let me know like what it is that you're interested in from either like other types of yield products, or if you'd like to get into equities or real estate. The world is our oyster, if you will.
Yeah, definitely the most exotic private credit fund that you have. I think crypto people will love that.
Okay, we'll look into that.
And Tarun, tell us a bit about what Gauntlet's been doing with private credit positions. I know we talked a lot about leverage strategies today, but tell us what that's looked like, and has demand been strong for that?
Yeah, so maybe I'll give a kind of personal anecdote as to why I find this kind of the most interesting kind of part of crypto right now, even though like it's not like the sexy thing that you're going to get a big news article about, is basically when I first started in trading, 2010, 2011, there was no retail flow, right? No one really cared about the Robinhoods or Public. Well, Public definitely didn't exist then. Like no one really cared about at that time, basically only Robinhood. And everyone kind of was like, retail investors are never going to invest in the stock market. They're all going to buy passive index funds. No one's ever going to do active investing. No one's going to buy single name stocks. If you believed what the news told you then, you were completely wrong and probably missed out on most of the alpha of the 2010s investing period. And most of that was enabled by allowing easier access to equities, right? Because before you would have to like pay a lot per trade. You'd have to get a brokerage account. You couldn't kind of like invest $2. And I generally think the last bastion of private funds that has had trouble getting access to retail investors has been these kind of levered funds, credit funds, private investments. One of the reasons for that is that those types of investment vehicles just have a ton of covenants. They have a ton of rules about when you can withdraw. They have a ton of rules about how you have liquidity. And managing that in a retail-friendly experience has basically been impossible. And I think crypto is the only place you can enforce all those rules to a standard that an investment manager would be happy with, while also being able to provide quick liquidity when needed. And so from that perspective, if you think about vaults that are managing private credit positions, the goal is, as a vault manager, to allow for maximizing users' yield. Obviously, that's what people really want, while also making sure there's enough withdrawal liquidity. So, a little bit like in a bank, you have duration risk. You have to think about, how much liquidity do you plan, how much is there, how much you expect in withdrawals, combined with some notion of, what the default rate is. Are there enough liquidators? What is sort of the on-chain type of risk? So you sort of have a few different components. One is pure yield optimization, alpha. One is sort of understanding users' behavior, like, hey, what are deposits and withdrawals? And this is those two are sort of like TradFi-like. And the third is the DeFi risk component, which is generally unique. And I think these types of products are the first ones where you have to do all three. In general, historically, DeFi products have been, the yield has been sort of reflexive. So you didn't really have to think about the yield optimization and duration management positions. Or it's something like staking where there's just a fixed duration, there's not that much you can do, and LSTs are the best you have. And so when we think about this, we think about A, the user behavior, like how much leverage should they take safely, and then B, and I think this is a fundamental difference between traditional finance and crypto, is everything is in crypto that has been successful is variable rates, no fixed duration, right? Like exactly the opposite of everything in traditional finance. And so you have to also manage the positions thinking about the overall borrow rates, right? So maybe we see that borrow rates in Ethereum have actually, on Ethereum lending protocols, have spiked. And there's a question of how long does that take for Solana lending rates to go up? Stuff like that actually impacts how you do this type of optimization, and holistically, that's kind of how we view it.
That's amazing.
We're treading a whole new ground here.
Yeah.
Exactly. And yeah, having products with no like real oracle, bringing the oracles on chain for something like ACRET is also very interesting to us because we think a lot about, obviously the title of this panel, real money, real assets, real time. What are the risks on the DeFi side for housing assets like private credit? And the infrastructure today is actually enabling us to be able to price these things on a real-time basis. So that's really cool to be able to launch this with you guys. Now let's kind of bring it back to the future, where we're going. We're very excited about this pilot product. Gauntlet's going to be launching vaults on Drift within the next couple of weeks for this product. And I want to know, what are some predictions you guys have of where DeFi TVL is going to go in the next 3 years? I really want, obviously, I'm a big DeFi bull, probably the biggest there has ever been. But yeah, I want to hear from you guys in terms of broadening that perspective as well. Where is DeFi TVL going? And what is your bull case for it?
I'll let Tarun start.
So there was a very funny European Central Bank report like 2 or 3 weeks ago that was mainly a fear-mongering thing, I think, because like Europe seems very afraid of like dollars flooding Europe and everyone spending dollars in Europe, which claimed that by 2028, stablecoin TVL will be 2.8 trillion, right? You know, that's like a 10x from now. So if we just take that and assume DeFi gets a large multiple of that, even 80%, that should mean 1 to 1.5 trillion by 2028. So I'm taking the European Central Bank's prediction. I'm not even giving you my own. Again, I think that was a little bit to like scare regulators there into like passing some legislation. So there's some chicanery there. It's not totally a well thought out argument. Yeah. But I do really think stablecoins going over $1 trillion or 2 trillion seems totally feasible in the next 3 to 4 years. And if you think of DeFi as beta to stablecoin growth, then you should expect how you pick that multiple. I'll let everyone pick their own Oracle method, but that's sort of I totally see stablecoins in that range soon. And I also think in general, as I mentioned earlier, I think like DeFi versus L1s and infrastructure is just like incredibly underpriced. I would say like as an investor, that is where I am definitely looking for like value right now, because I think like there's just so much actual usage happening there, and yet the token prices are kind of really depressed. So
not financial advice, but
not financial
love that.
advice. I'm just saying my own what I'm doing.
So my boomer point of view is like less about like what is the size of the market, but more like what is it going to look like. I mean, as I mentioned, my starting position is I think about DeFi protocols as the engines behind like a really amazing user experience that has yet to be developed. But in reality, what this looks like is like DeFi engines powering the financial service activity of like fintechs and asset managers, potentially banks, if they're able to move fast enough. And like it just kind of like folds into the background. Now, one of like the really interesting things about blockchain technology that I like think is kind of like understated, if you will, is that you're essentially bringing together many different types of assets to get together in like the same operating system. And then you're making it programmable. And I think we underestimate the power of this, right? So like, tokenizing Apollo private credit can sit alongside Solana, can sit like as like a native cryptocurrency, can sit alongside some treasuries that BlackRock or money markets that Franklin has, put on chain, and then everything else in the world. And then the other interesting thing is that it actually doesn't even matter if it's natively on chain, like some of the native crypto or the native assets or the on-chain lending that happens in DeFi protocols, or if it's something that like lives off chain, sits in custody, sits in like some other books and ledgers, and is like brought on chain. Like it's all sort of on the same operating system and programmable. And like I said, because everything is like sort of programmable and battle tested, what that means is that you can essentially build super customized experiences at any size, right? Because we talked about the scale. Like, doesn't matter if you're like, a few dollars to like hundreds of millions of dollars. Like, it's kind of the same activity. It's the same motion, if you will. And so the net effect is that essentially everyone globally, banked, underbanked, not banked, like will be able to have access to a diversified global alpha and yield generating portfolio that is customized just to them and their risk profile at a low cost basis. And that, I think, is liberating for everyone, because what are we all here for? I mean, like, we want to live our lives and AI are going to take over, but like, it would be great if we had some yield generation and some like productive investments that can hold us down while that's happening, right? So, that's sort of the vision that I have for DeFi. So less about the scale and size, but more about how it ends up maybe fading into the background. And I know, like, Tarun, you and the team are going to be sad from a research perspective, but becoming the engine of the financial system, and more significantly, ensuring that people can live the lives that they want to live, like with the yield and investment generating assets that they can have.
I like the anti-dystopian novel that Christine just suggested, which is actually
We're all going to be like Wall-E. We're going to just be floating around and like looking at our investment portfolios.
And we're going to earn yield from the AI because we're going to be lending to them via private credit for the GPUs.
Exactly.
That's like the cycle of life.
And by the way, we didn't even talk about how AI needs yield also, right? Like they're going to have wallets and need to do things.
So yeah, we're gonna stop working and rely on Apollo's credit funds to fund us for the rest of history. But thank you so much, everyone, for listening in today, and thank you so much to my wonderful panelists. I've never been this bullish on DeFi, and this has really presented our vision for the future, our vision for Drift Institutional, and where we see the space going. So thank you so much.
Thank you.